Everybody, this is Dr. Flight. Hope you're doing great today. It's a pleasure to be with you and talk for a little while about this idea of portfolio planning. And when we talk about portfolios in marketing, we're talking about um, uh, groupings or collections of products and services, which are cash flows, that go together or that go in a composite or a bundle to make up what your company or your business offers as value, as products. So if you take all your different products together, we want to manage those. We want to manage what our revenue expectations are for each one. But then when we talk about portfolio planning, what we're really doing too is we're thinking about these cash flows over a lifetime, the length of the product life cycle, and how that product we think will perform and add to our collection of products as we go. So I'm going to show some visuals. We're going to walk through some examples. If you've had a principles of marketing class, then you're going to be familiar with a few of the ideas here, but this will also be a lot broader too and give you a little bit more depth than maybe what you've seen in the past. So to introduce this topic, let's talk a little bit about Apple. And we're going to specifically talk about the Macintosh computer and the iWatch, or their Apple Watch, I guess, would be the way we think about. And I want to think about these two products within the portfolio of products that Apple offers. Now, Apple's an interesting company because they're wildly successful in lots and lots of different ways. They're very profitable. But if you look at like the products they offer, they really don't offer a lot of products. They have a few platforms, and they operate in a handful of product categories, but they are not exceedingly large or deep in any of those categories with their product offerings. So let's think about again the Apple Watch and the Mac, and we're going to look at two different dimensions, which are kind of popular to look at. I would add a third maybe down the road, but most planning models look at two. And one would be when we look at a product's category, we want to assess how attractive the category is. Typically, what we're going to look for is how fast it's growing, how large it is, how appealing and profitable that product category is today and becoming in the future. So market attractiveness is something that we look at. You can take a look at the illustration of a product life cycle chart, which would be that curve that you see. When we look at demand for a product, which would be sales of a product over a period of time. When we draw the product life cycle curve, it has different parts where the sales are increasing at an increasing rate. Then there's an inflection point where they are increasing at a decreasing rate, sometimes called the growth stage. And then they hit another inflection point or where the curve takes that first deviation, if you will, where we begin to decrease at a decreasing rate, and then eventually in deep decline you decrease at an increasing rate. So think about like the Apple Watch. Again, Apple Watch is probably in the late growth stage, maybe even in the maturity stage, as far as that product category. But certainly it's not a new product newly introduced. It's not in the early stages of growth for sure. Think about the Mac at the same time, and it's further along in that curve. It's a product in a product category. The product category, it's growing, but not growing at an enormously rapid rate like it was when personal computers were first introduced in the early 1980s. So now we're 40 years into that product category, and it's deep into the maturity stage when you think of, and this is primarily a home desktop computing solution. Other things have taken its place, like tablets and laptops and things like that. And you should separate those out from a product category standpoint, but you can kind of see how, you want to be at different points in this curve, and depending on what your strategy is, it'll suggest that that's true. Second component that we look at when we look at product planning portfolios is your firm's ability to compete. And you can say, well, what position in the field of competitors do we hold? Like in Apple's case, when you look at computing desktop computers, they have an extremely small market share. They don't have a very strong competitive position if you think about the overall product category for desktop computing. It's not a strength that they hold in a competitive position. Now, flip that over and look at Apple Watches as compared to other types of digital watches or computerized watches, or whatever you want to call them, and they have a very strong market share, 62%. So if you think about like strong market share in the earlier stages of the product life cycle, that would be a very attractive product to have in your portfolio. Very small market shares in the late stages of your product life cycle, then you'd probably be less inclined or less enthusiastic, at least, to have those types of products in your portfolio. But then again, a mix is often good. Again, when we look at portfolios, take the analogy of a financial portfolio where you have different investments, maybe for your retirement account. Some of your investments you might want to be aggressive with, some that are more risky, some that you're not quite as sure about, and then others, though, you want to balance your portfolio. If you think about the balanced risk of your portfolio and betas and things like that, you want to add in some safer investments that have a more guaranteed return or less risk involved return. Now, the returns are going to be smaller, but your risks are lower as well. So when you combine the low risk investments with the high risk investments, your portfolio might be something where what you want to be. Now, most certainly it's true that some people want more risky investment portfolios, other people want less risky portfolio investments, and companies do the same thing. You'll see portfolio A on the left hand side of the screen, where you have a bunch of products. The company has lots of products that are in the late stages of growth, stages of maturity, even stages of decline, and they have absolutely no new products that might be future products that are riskier and have more potential upside return. That's a very conservative portfolio, by the way. That's like having a lot of CDs and money market accounts that are they're not risk-free, but they're pretty close. The portfolio on the right is a more balanced approach. It's a more balanced portfolio where you have some new products where you don't really know what they're going to do, but they show great potential. That would be product E and D. But then you have other products that are further along the product life cycle, A, B, and C, which are kind of the tried and true. A and B for sure, more successful, but also you're dealing with a lot more competition, and the market's maturing, so the growth for the future of those particular products are going to be flattening out. Okay, a little bit more balanced is the best way to describe it. It has a little bit more risk in some cases. But your risk of E and D products are balanced out by the security of A and probably B as well in this particular case. So again, kind of just continuing on with this idea, products in the later stages of the product life cycle, when you look at the profit curve, tend to generate more profit, or probably revenue too, because you're selling more units, but there's certainly greater profit margin in products that occur later in the product life cycle. And so you have this abundance of cash coming in, With the noticeable lack, though, of products in the early stages of the product life cycle, you have to question what will the future cash flows be like for this company. Just again, from a personal finance perspective, imagine all of your investments are in are in bonds or CDs which expire, which mature. Well, what happens after they mature? What's the money going to go into? Now, in that case, it's probably easy. You just roll them into new financial instruments. But creating products and cash flows through products is much harder than simply rolling your investments into something new. You have to create those new products, and that begs the question with this company in terms of what they might do. Now, you might say the same thing if you are overly weighted in products in the early stages of your product life cycle. This while the image of portfolio B doesn't 100% show that, imagine if you only had products that were near E and D and early stages of the product life cycle, they're in the introduction stage, and you had no products later on. Then you'd have an overabundance. You'd have lots and lots of products that are incredibly expensive to build and maintain, to grow market share and defend against competitors. And you would be lacking that balance of older, more seasoned products that help, again, balance your portfolio out. So those are the things to consider when we start looking at portfolio planning, when we're talking about products and kind of how that works. We've got some tools which, again, you're going to probably see make sense or remember from other classes. And this image is a little cumbersome, no lie about that. There's two things that are happening here. One is you've got the product life cycle flipped on its side on the left-hand side. And again, that's just the product life cycle chart that you see in all kinds of other cases, but it's on the left-hand side flipped sideways. In the right, you see a 2x2 matrix. The 2x2 matrix gives us the coordinates or the bounds, the axes of market growth rate, which you might also think of as category attractiveness, like is the product category attractive or not, and what would its growth rate be. And then on the x-axis below is your firm's competitive position. You might also think of this as the degree to which your company is able to compete among others in that product category. And before, we saw an example of that with market share for Apple. Now, looking at this and kind of combining these two things, the market growth rate maps to and is in kind of correlation with the product life cycle chart. Products that are in the early stages of the product life cycle have a much higher growth rate. Their curve is going up sharply, right? Remember that? But then it flattens out and then becomes negative. And so if you kind of pan up and pan down and then over to the left, you'll see that the degree or market growth rate goes up, and then it starts to slow down at maturity, flattens out 5%, 0%, and then starts to go down during decline. So we're moving from the top of the matrix down to the bottom as we go left to right on a product life cycle chart. The other thing that you're going to see here is that we have products in the matrix that are positioned based on those two criteria. So if you were to say, for instance, put that Apple Watch in there, Apple Watch for Apple, it's going to be probably maybe a little higher on the chart than where A is, but probably pretty close to A or a little higher there. The MacBook or the Mac desktop computer is probably going to be like where D is, only way down here, down towards the bottom of where it's close to 0% growth rate, maybe 5% growth rate, something like that. But it's going to be like in line with D going down. So you kind of get this idea of mapping on the product lifecycle chart, but now we're going to map it in a 2x2 matrix. And now we can also form an enormous number of different strategies with these types of products. You're going to remember, again, these different names: question mark products, star products, cash cows, and dogs. Well, that's called the Boston Consulting Group Growth Share Matrix. That's what the term is for that matrix. And this chart that we're looking at is very similar. The only difference is when you look down below here, it'll say share development or market share. In the BCG growth share matrix, it'll say share, and before it just simply said category competitiveness or competitiveness for the firm. But remember, like, we have these positions. Dogs are products that you don't have a lot of market share in and the growth rate is fairly slow. Question marks, you don't have a lot of growth share or market share, but the prospects are extremely high. There's a lot of growth. They're probably introduction stage type products. Stars are products that you have developed. They're well into the growth stage, like the Apple Watch for Apple. And you have enormous market share, or you have a strong position in the market, in a competitive position in the market for it. And cash cows are these ones that they're typically products in the maturity stage, late growth stage, maturity stage. They're products that you have a good, solid market share, competitive position in. However, the prospects for that product category have now softened. They're lower. So product A then is in that category: slow growth, near full share development, maturity stage of the product life cycle. B is one of those products that is rapidly going to become a dog, probably, once you start divesting. Now, you haven't started divesting. You haven't started harvesting. You haven't started withdrawing funds from that, diverting funds from that product to others. So your market share hasn't dropped, but it could happen. It could happen if that becomes the particular case. And you can kind of just pause the video if you want and look at some of these other positions here and how you would categorize them. But again, if you've taken a marketing class, no doubt you've seen this concept called the Boston Consulting Group Growth Share Matrix. And this is just another variation of that, or that's a variation of portfolio planning and management that you'll see. So next, once you've kind of agreed that you know where your products lie, your portfolio is in this picture, the next question is, what do you plan to do with each one of these products? How do you want to manage them, and what would you like to get out of them? So in product A, this is a cash cow for you. You want to get as much money. You're going to be defending from competition still, probably maintaining your market share. It's huge as it is, huge market share, huge dominance in the market. You don't want competitors to start chipping away at that. So it's not like you're looking to grow market share. You're looking to defend market share and continue to satisfy your customers, create loyalty programs and things like that. With product B, again, you could see where this product life cycle is probably coming to a close. You're probably going to start losing buyers. Buyers are going to become fewer and fewer. Most people have bought in this product category by this stage. The growth rate is becoming negative. So at some point, you're going to want to start limiting how much money you invest, which would be called harvesting. You're not selling the product off. You're not getting rid of it. It's still profitable for you. You're still making money from this product, but you're making less and less money each time period moving forward. So it's not like you want to just get rid of it, but you don't want to necessarily invest more in it because it's not going to continue to grow for you. Product C. So product C is one where, what you'd like to do is take share away from others so you could grow your market share. Since it's still in a cash cow position, you're not in a strong cash cow position. So in other words, there's opportunities here for you to grow revenue, not from market growth, but from taking existing customers from other competitors. So your strategy is going to change a little bit in terms of how you're going to maintain that. And you want to grow it into the size of A. You want it to be a big player in the market. But it's not going to come from new customers. I mean, that growth is not going to. It's going to come from existing customers. Those existing customers are from your competitors. Product D is an opportunity. It's a future product that it's tomorrow's future. It's something that's going to grow in the future for you, and you want to be able to, again, invest so that you can grow your market share, but also ride that wave of popularity because it's still in it's in the growth stages, and growth is happening rapidly in that particular product category. So you're going to have to, as you're building your brand, you're building your product, you're establishing your market, you're defending yourself very heavily against competition until the weak competitors leaving you more market share. It's one of the strategies that we're gonna want to do. Okay, and product E, again, still high in the growth space. However, in this case, you're probably a pioneer. You're probably the one who brought the product in for the first time. Maybe you're an originator. You have the first product out there. You have first mover advantages. Again, you need to capture market share as the market develops, defending yourself against competitors. You're probably the first mover or the pioneer in that particular product, and you want to act like it. You want to be the leader of the pack on that one. Okay, so again, lots of strategies we can do here, and it really involves where we are and what we look like, in different places. I'll give you a little example of portfolio strategy. This is an older example with Yum Brands, who would have different restaurant brands associated with it, as you may know. Taco Bell, Pizza Hut, KFC are the three big ones. And at the points in time, 2011, you can see that these brands, along with Long John Silver and A&W, were kind of held different positions. So we have opportunities for growth again, and then market share on the bottom, just like our other charts, but we can kind of see the relative position of each one of these. So, while Pizza Hut, you don't have a particularly large share, was at the time a very growing space for pizza joints, things like that. And so defining that space was a good thing. Same with chicken. And to a lesser extent, growing Taco Bell, but having a smaller overall share of that Mexican or Hispanic food options, I guess. But take a look at the performance over time from 2006 on up to 2011. Steady revenues, steady operating profits, which again, if you look at operating profit as a percentage of sales, think of that as like profit margin, basically. You take your profit, divide it by your sales revenue, and you get a percentage. So you can think of this as like profit margin, but also an efficiency thing. They're becoming more and more efficient at making profit out of revenue that they've been creating. So that's a very good thing. Noticing, however, in 2011, a dip, and maybe a reflection and a time to say, well, look, what should we do with these brands? How should we move forward? And their decision at that particular time was to invest and grow Kentucky Fried Chicken, Taco Bell, and Pizza Hut. That was just a strategy that they wanted to consolidate resources in highly profitable brands or product spaces, ones that they have strong growth and or strong market share in their position. So they decided at the same time to divest and to spin off and sell off A&W and Long John Silver's, simply because these aren't they're underperforming, and or they don't have a strong foothold in the marketplace, or the market's just not developed. It's not growing for them. So there's a conscientious decision to become smaller in order to become better, if you will. They also, at the same time, used the money they freed up from their Long John Silver's and A&W properties to reinvest in new growth strategies for their big three, moving them more internationally and finding new markets for them to grow in. Okay, so this is like a real play on how you can think of portfolios, and obviously there's a lot of strategy involved, and there's a lot of just it's like a thought exercise to see what you might do moving forward in the planning process. Okay, a couple other things that we'll look at, and later on in the term in other lectures, we'll talk about specific offensive and defensive strategies, especially around products and brands, how you can grow, how you can defend, how you can protect things that you're going to do from a product portfolio standpoint. Just simply, this image should emphasize this notion that when you're in the early stages of the product life cycle, and that's where your products lie, oftentimes you're looking to be aggressive and to push an agenda, push your market, push your product against your competitors to gain market share and competitive positions. When you're in the later stages, we're often more defensive. We're more inclined to protect our share and protect what we have, and that's oftentimes the way this works out. We had one example earlier where you may be in a later stage of the product life cycle, but you want to grow more. But anyways, this typically is the setup and how you'll see things like this, where you invest aggressively early, you defend passionately later. And that will usually make sense. The last thing that I'll talk about, and again, this is another interpretation of this model. So this is a base model. There's at least 3 or 4 different popular interpretations of it. The Boston Consulting Group Growth Share Matrix is one. This one here is an overlay of, again, now don't get confused, some of the arrows are reversed, but it's an overview of this market attractiveness versus your business or your competitive position in the in the product category by Peter Drucker. Peter Drucker was a management consultant and professor for many, many, many years, and he has written many influential theory and models to help explain how business works. And so he defined some of these different product categories in the following ways. So he had a term called today's breadwinner. So this is a product then. We might think of it as a cash cow, products that currently financially support the firm. They support the infrastructure. They also, very importantly, contribute heavily to the fixed costs that a company will have. A lot of times, early products in the early product development stage and introduction stage are simply paying off their own existence. They're not contributing much to the firm, but today's breadwinners are. So the today's breadwinner concept, that would be down in this area here. Okay, tomorrow's breadwinners up here are the things that we would call stars. They will in the future financially deliver to the company. But they're not there yet. They haven't quite been established as the clear-cut winner. It's a star probably, maybe a question mark, but probably moving into the star area. The tomorrow's breadwinners. There are a number of question marks. These are ones that would be up in this upper right corner. Development products, sleepers, and investment egos. These are big question marks. These are products that need a lot of financial investment. We don't know entirely what their future payout's going to be. Sleepers, they haven't either successfully reached profit margin that we need, or they haven't reached a sales plateau that we need. There are perhaps signs that they will do that. There is some financial indicator suggesting a forecast that they will come through in the end, but it hasn't happened yet, and perhaps won't. Then the final category, and this is Drucker, of course, was a management professor, so a lot of his work deals with management concepts, and this one is one where somebody will put forth a project, develop a product. It won't be a particularly successful one, but the product champion, the one who started the product, has too much ego involved to let it go, to let it fail. And so it lingers, but it's kind of one of these products that isn't gonna that's likely not to be a real breadwinner for the company. The final category, or final sets of the other two, there's a total of 7 Drucker product types. Yesterday's breadwinners and straight up failures. And yesterday's breadwinners are those products that have gone through the product life cycle but are now in the decline stage of the product life cycle, and you're considering the divestiture of them or the harvesting idea of them. But they were great products for us, and we've now moved on, and that product needs to move on as well. And then finally, failures, products that launch but never take off ever, and they're deemed they're just unsuccessful products that and in marketplace, depending on your product category, you could have a very high percentage of failures. If you're putting out lots of product concepts every year, you might have 10, 15, 20 higher percent failure rate of your products, and that's what that is. We might call them dogs in this particular case, just if you wanted to continue those terms and kind of think about what these types of products from Drucker's mind are superimposed on a Boston Consulting Group model. So this is this whole idea. The last component that you'll see in this are the interior drawings. When we develop and move products through a product life cycle, and we think of them from a portfolio standpoint, we want to conceive the product, invest the product, grow the product, and then see it all the way through maturity. That's the goal. So we want to use the solid line here, and we want to go from right to left, and then down. So we go from development projects, tomorrow's breadwinners, to today's breadwinners. Now they will eventually make the full circle over to the dog category, but the goal is to move them from the development to tomorrow's breadwinners to today's breadwinners, right? That's kind of how we want to make that happen. Now, what we don't want to do is move quickly to the failure space or the dog space. So the dotted line is where things don't go well. I'll argue a little bit that moving from the breadwinner to the failure space or to the dog space is a part of the natural progression. So in some cases it's not avoidable. In some cases it happens, but only because it's been a success in the past and it no longer is. There are a whole bunch of reasons why that happens, but that may be a one argument you could see. But in every other case, you don't want a failed product. And so we want to make sure we're managing the product through the product life cycle in ways that are appropriate. All right, so this is a discussion. This is a really, really big, cool idea when we start strategizing what your company's profit centers are, where your cash flows are coming from, where they will in the future, and going off of that. And this is, again, one of our marketing related big concepts. So let me know if you have any questions. Hope you have a great day. Talk to you soon.